Okay, so we started the music with some Dancing Queen from ABBA. So I think that's a good way to start with the year test coming up. Remember, when it gets too much, there's always something you can do. You can always go and put some music on and do some spontaneous dancing just to relax and get the blood flowing again. That will just give you the strength to carry on and to sit down again and to start studying again. Okay, so yeah, so welcome, our last lecture of this quarter. Very exciting. And only 2 sleeps to go before your first year test. So that, and you're starting off with a bang, you're starting with FPS. So that will be fun. Okay, so we are finishing up with leases then today. Okay, what I'm going to do, I'm going to hide your chats while I'm lecturing, and I should have done that a long time ago, because I do get a little bit distracted by that, and then I stop in mid-sentence to answer chat, which is not always that much fun, especially if you're watching the video afterwards. So I'm going to hide the chats and then just open it up when I'm ready to address your questions. But please, no questions on 300 in the FRK 300 lecture, okay, or Audit 300 or FPS. Please, let's stick to FRK 300 for now. Just another hour and a half, and then you can go and jump into FPS, whatever you want to do. Okay, so like I said, we're finishing up today with the with IFRS 16. So what we are going to do today, we are going to focus on the operating leases. Oh, now screen is not updating. Let's see if it's Hendrikie. Sorry, we're just having some technical difficulties. The screen is not updating. So just a moment. But anyway, we are going to start with or look at operating leases today. That will be the focus of the lecture. In yesterday's lecture, I started talking to you about the manufacturer dealer lessors. So what I've decided, as I told you yesterday, that is that is on awareness level by SICA. So SICA said you guys should be aware of it, which does not mean they can't test it. That doesn't mean you won't ever see it in the ITC or in your tests or exams. It just means that we are not going into so much detail on the manufacturer or dealer lessors. So what you can do is you can what you can do is you can go and I loaded a little video for you on ClickUp, 10-minute video on the manufacturer or dealer lessor. So you can go and have a look at that. Okay, let's see if we can fix our technical issue now. Why not sharing? Why did it stop sharing? No, I don't want to share PowerPoint. I want to share my screen. There we go. Start broadcast. Just another second. Hang on there. Okay, it's sharing now. Is it fine? Is it paging? Yes, cool. Let's see. Let's hope it lasts. Okay. So we're looking at operating leases, and then we're finishing up with IFRS 16. Okay, so on the manufacturer or dealer lessor, as I've told you, there is a short little 10-minute video. You can go and have a look at regarding the manufacturer or dealer lessors. So the biggest thing there that you have to note is just we've got these 3 differences from the incidental lessor. The first one is that your initial direct costs, we take straight to cost of sales. So that is not a we don't capitalize that as part of my my lease transaction. And the second thing that you have to know is that we will have 2 journals. So we are going to have a revenue journal, and we are going to have a cost of sales journal. And then the last thing is that we will just have some additional disclosure of the profit that we got from the sale as a manufacturer or dealer lessor, which will be the difference between the revenue and the cost of sales. Okay, so basically that's just those 3 things, the differences between the manufacturer or dealer lessor and the incidental lessor. But there's a 10-minute video for you on ClickUp. I loaded it yesterday already, so you can go and have a look at that. And on that, on the before we now jump into the operating leases, on the incidental lessor, so a lessor that's not a manufacturer or dealer lessor, you'll see I also loaded a video for you on examples 13 and 14, that just gives you a more detailed explanation of how we got to those amounts. So the thing is, with that example in class, I focused on the disclosure because that's the point of that example. But the fact that we have this issue where our lease year and our financial years do not agree complicates the calculations in that example. So in the video that I loaded for you, there's a in detail you can see how all those amounts were calculated. Good. So now we can jump into our operating leases. So first of all, what is an operating lease? So an operating lease is a lease, and this comes from Appendix A, definition of an operating lease. Oh, no, there we go. Okay, so from Appendix A, the definition of an operating lease, it is a lease that does not transfer substantially all the risks and the rewards incidental to ownership of the underlying asset. Good. So we've already looked at these risks and rewards when we started with the lessor, because remember now, a finance lease is a lease where these risks and rewards are transferred to the lessee, where here the risks and the rewards stay with the lessor. Okay, so that is what an operating lease is. And then remember, in paragraph 63 and paragraph 64, we were given those indications that help us to decide whether a lease is a operating lease or a finance lease. So obviously all of these paragraphs and these indications we also have to consider that when we get to operating leases to decide whether it's an operating lease or not. Okay, so now we've looked at that, and we've looked at all the risks and the rewards. Have they transferred to the lessee? No, they stayed with the lessor. We also at these indicators that the standard gives us, the examples almost that the standard gives us of when it might be that the risks and rewards have been transferred, and we decided no, this lease is definitely an operating lease. So now we have to start and measure this lease, recognize this operating lease. Okay, and it's actually so straightforward. An operating lease, the recognition thereof is actually very straightforward. So we find the initial measurement in paragraphs 81 to 86 for an operating lease. Okay, so in paragraph 81, we are told that a lessor shall recognize the lease payments from the operating lease as income on either a straight line basis or another systematic basis. The lessor shall apply another systematic basis if that basis is more representative of the pattern in which the benefit from the use of the underlying asset is diminished. So this means that if the benefit that the lease payments, the income that I'm going to get from this leasing out this asset should reflect the benefit from the use of the underlying asset. Okay, so if the benefit is going to be bigger at the beginning of the lease term, then obviously the income will be bigger. And if the benefit is going to be smaller at the end, then the income will be smaller at the end. So then we won't straight line. However, if the benefit is going to be the same for us, then we will use the straight lining to recognize that income. Okay, now. So if, for example, if that asset for the first few years we know that whatever this asset now manufactures is going to be the market wants this, the price for this, I'll be able to lease it out for a higher value in the beginning, but after 2 years, then there won't be as many people who would want to lease this asset, so the benefit for me as the lessor to lease it out will decrease. Then that is also the way that the income should be reflected in the statement of profit or loss with regard to my lease income. Okay. So, however, if it is something that's the benefit for me is actually going to stay the same, but I just decrease the lease payments to incentivize this lessee to lease it with me for a longer time, then that means that I'm going to use the straight line basis. Okay, but in a question we will give you proper guidance to. So you will default to straight line unless there is specific information that tells you that there's another systematic basis that better reflects the pattern of the benefit from this underlying asset. Okay, So that's paragraph 81 that says a straight line, or otherwise, if we can justify it, another systematic basis. Next, in paragraph 82, they tell us that we recognize all costs, including depreciation, incurred in earning the lease income as an expense. So any cost that we have will be recognized as an expense. Good. Now, on that depreciation, we will calculate the depreciation as for any other similar assets. So if we are leasing out an asset from category A, this type of asset, I'm leasing out this asset, then the depreciation on that will be calculated in the same way as I would calculate depreciation on the other assets in category A. Okay, so that's what IFRS 16 tells us here. And then also we have to remember that if there's any impairment, then we will recognize that in terms of IAS 36. Okay, so we are going to get to investment property. No, sorry, I-38 is an intangible asset. We'll get to that later, so don't worry about that now. But just so the depreciation is calculated in terms of IAS 16, whereas impairment we have to consider IAS 36. Okay, then what about initial direct costs? If we have any initial direct costs for this operating lease, what do we do with that? Paragraph 83 tells us there that if the lessor has any initial direct costs, then that will be added to the carrying amount of the underlying asset and then recognized as an expense over the lease term. So basically what it means is if we have initial direct costs for an operating lease, we will add it to the amount of the asset, but appreciate it over the lease term. So it becomes like a component. You remember I 16 components of assets that are depreciated in different ways over different useful life terms. Well, the same thing happens now. So we might have our asset that's depreciated over 10 years. We have some initial direct costs when leasing out this asset, and we're going to lease it out for only 4 years. Then what happens is we add it to the asset, but we depreciate those initial direct costs over 4 years. Okay. So that is with regard to the initial measurement. Let me just make sure. Oh, yes, just one more note. If we are a manufacturer or a dealer lessor entering into an operating lease, then there is no selling profit or anything like that. So the treatment of an operating lease for a manufacturer or dealer lessor is exactly the same as for any other lessor. Okay. So that is then my initial measurement of an operating lease. Let me stop quickly and see and just check if you are talking about relevant things and not about all kinds of nonsense in the chat box. Okay. Okay, should it reflect the benefit from the use for the lessee? That's a good question, not the lessor. That's a good question, Ms. Swanepoel. So if you think about, if you look at the paragraph, it says the lessor shall apply another systematic basis if that basis is more representative of the pattern in which the benefit from the use of the underlying asset is diminished. So it doesn't specifically speak about the benefit for the lessee, but it is the benefit from the use of the underlying asset. So that's why I said if we have a situation where in year 1 and year 2, this type of asset, everyone would want to lease this asset because the benefit of getting this asset, making the inventories that this asset produces will be bigger, then the lease income that we are going to generate or recognize for these 2 years will be higher than what it would be for the next 3 years. I always think about what was that frozen yogurt place that was so popular a few years ago? You guys would have been like early high school. Wackaberry, yes, Wackaberry. So that's maybe one of those things that maybe in the first 2 years everybody will want to lease my frozen yogurt machines because this is going to be such boom. So therefore, I would be able to lease it out for a higher amount for the first 2 years. But then I know it's probably just going to be a craze. So the benefit in the years after that will be lower because then there will be something new coming out. So therefore, I can tell the lessee, okay, I'm going to ask you a higher rent, higher lease income or lease expense for the first 2 years, and then a little bit lower for the next 2 years, because I think that is, that reflects the benefit that you're going to get from the use of that asset. And if that's the case, and I can justify that, then this is the way that we will recognize the lease income as well. Okay, cake sherry, blackberry, wackerberry, whatever. Mr. Armstrong, you and Mr. Groenewald obviously are suffering from pre-traumatic stress for the year tests looming. So I have no idea what you're talking about. So therefore, I'm going to, almost hide the chats again. One more valid comment. So the benefit of the use kind of coincides for the lessor and the lessee. Yes, but not necessarily. When we had our low asset value leases for the lessee, remember there we said that we are going to also straight line the lease expense, and there it specifically referred to the benefit to the lessee. Where here it doesn't talk about the benefit of the lessee, it does say the benefit from the use of the underlying asset. So there is a link, but not necessarily. Okay, whatever, Mr. Armstrong. I'm going to hide you now again. I actually love the chats and the comments, but I can understand those of you who are a bit more serious that it can be a little bit distracting. But I love interaction. It's so much better than just recording a video, I promise you. So thank you so much to the, how many students do we have this morning? 157. Thank you so much to the 157 of you joining me live, because it's very boring just to talk to myself to a camera, which is exactly what I'm doing now if I think about it, but at least I know there are 157 people listening to me now. Okay. Okay, so we have spoken about all of this. Now we get to example 18. So in your notes, example 18. Let's see now if this works. Okay, today I've got my examples with me. Okay, so open up your notes to example 18 and we will look at the initial recognition. Okay, Ms. Wanwu, what would be an example of no link? Well, I suppose if the lessee leases the Wackerberry machines, so that because it's a mom who has 14 children and wants to use it for birthday parties for her kids, and it's easier for her to do it that way than to lease it out every now and again. You know, that might be an example, a weird, simple, stupid example, I know, but the fact of the matter is just that the standard doesn't specifically talk about the benefit to the lessee. It talks about benefit from using the asset. Okay, so it's not linked to a specific lessee. Would we be given a pattern of income? It's not. Yeah, that's what I'm saying. In a question, we will make it clear that the benefit is not straight line. It will be crystal clear that the benefit that we are going to get is going to be will not be straight line. Okay, good. So example 18. So we're looking at the initial recognition of the recognition of an operating lease in the books of the lessor, not initial, overall, and subsequent measurement. Okay, so we have, it tells us that, oh, can I write on this thing? I won't be able to write here. Anyway, Muscat Limited has a reporting date of 30 June and entered into a non-cancelable lease of 1st of July X14 commencement date. Oh, thank goodness the lease year and the financial years are the same. Okay, so we can relax about that. So to lease a machine to another company who will use the machine in the manufacture of one of its products, Vino. At the inception of the lease, it was correctly classified as an operating lease. So there, I'm telling you, it's an operating lease. Muscat Limited accounts for all of its machines in accordance with the cost model of IAS 16. Machines are depreciated over their estimated useful lives using the straight line method after taking any significant residual values into account. Okay, so we know now it's an operating lease, so the lessor is not going to de-recognize the asset. The lessor actually keeps the asset in its on its statement of financial position, so there will be depreciation. The machine that Muscat Limited is leasing to the lessee in terms of the operating lease had a carrying amount of 320,000 on the commencement date. It was purchased just the day before, so therefore the 320,000 will also be the fair value of the asset, and the cost and the fair value. No significant residual value. Total useful life of this machine was 10 years, and the machine was available for use as intended by management on the 1st of July X14. There have never been any indicators of impairment of this leased machine at any of the reporting dates. Then they give us some more information. They tell us that the lease term is for 3 years, but there is an option to extend this lease term for another year. And at the inception of this operating lease, it was reasonably certain that the lessee will exercise the option. Therefore, my lease term will be 4 years. Lease payments are payable monthly in arrears, with the first payment payable on the 31st of July X14. And the initial lease payment amount for the first 2 years of the lease term is 4,000 Rand per month. Then it will increase to 4,200 Rand per month for the third year. So year 1 and 2, 4,000 Rand per month. Year 3, 4,200 Rand per month. And for the fourth year, it will be 3,500 Rand per month. The benefit of the machine to the lessee remains unchanged throughout the lease term. Ooh, so there now it refers to the benefit to the lessee. Okay, so but anyway, so there isn't any other information, therefore we are going to straight line it. Okay, so like I said, if we think about what the standard specifically says, we can actually we can talk a little bit about whether it should say whether the benefit from this specific lessee is relevant. But in this case, in the question, that's all we have. So yes, we are going to straight line it. Okay, Muscat Limited is responsible for the insurance of this machine. Each of the monthly operating lease payments specified above includes 250 Rand in respect of the insurance of the machine. Assume that this is the standalone selling price for insurance of similar types of machines leased out by Muscat Limited to leases in terms of lessees in terms of operating lease agreements. Okay, so we have some non-lease component for this lease, for the insurance. Okay, so we have to remember that, a non-lease component of 250 Rand. We'll get to that now. Okay, then the lessee is also required to pay an annual rent amount calculated at 5% of the value of annual sales of product Vino. This amount must be paid to Muscat Limited on the 15th of August each year. So that means 2 weeks after my, month and a half after my financial year end, then we will get the payment of the previous year's. So this is a variable lease payment we are going to receive that is based on the sales. But it's only going to get paid to us a month and a half after our financial year end. Okay, the annual sales of Vino have been estimated by management of the lessee to be as follows. So this is my estimation. Now, what happens with what happens in this question is I'm now trying to catch you to see if you are going to want to include these variable lease payments into your straight lining of your expense, of your lease, the lease expense, the lease income. However, know that first of all, these are variable lease payments, so they are not part of my lease payment definition. Remember, lease payments, the definition says it's only variable lease payments that are linked to an index or a rate. So here the lease payments are linked to the amount of units that the or the sales of that the lessee made of the product that it manufactured using this machine. So therefore it's not part of the definition of lease payments, so therefore it will not be included in my straight lining. Okay, so I'm trying to catch you here, also giving you the estimated sales. That's irrelevant. We want our actual sales, and then we want to calculate what's the lease income then these actual sales, and then we'll recognize that as income. Okay, so they say the annual sales amounts attributable to the increase in the selling prices of the product of Vino. So yeah, so I suppose they're telling us this to just say that this increase is attributable to the selling prices. So the benefit that that the lessee is getting from using this machine to manufacture the vino is still unchanged. It's just the selling price that's going to increase. So therefore we are still going to straight line. Okay. The lessee incurred initial direct cost of 500 that it paid in cash on the 1st of July 2014. Who cares about the lessee's initial direct cost? We don't care about that. The lessee has to care about the lessor's initial direct costs when it has to calculate the interest rate implicit in the lease, but the lessor does not care at all about how much the lessee had to spend. So we are only worried about Muscat Limited, the lessor's initial direct cost of 480. That it paid in cash on the 1st of July. Okay, so initial direct cost for a lessor on an operating lease, ding, 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 warning bell. What do we do with that? We are going to capitalize this 480, this 480. We're going to capitalize that to the asset and depreciate it over the lease term of 4 years. Okay, so that's the information in the question. So before we look at the recognition, I'll quickly just check the chats if I can. Come on. Okay. Good. Let's see. Can you tell us for the first years if we are getting finance or operating lease? Mr. Mangali, I said relevant comments. Okay. Mr. Shrempel, this is my evil eye. I am now talking to you, all of you. Keep the comments relevant. Okay. Mr. Mangali, do not listen to Mr. Armstrong. Okay, let's see what else. What other silly comments do I have? Try using the draw button. Thank you, Mr. Plessis. I should have tested that before. Please remember to complain about that to my to your class reps. Or you are one of the class reps, so you can just complain about that yourself. Will we use the estimates in the disclosure as with the lessee? Okay, I answered you that. We'll no, we won't, because that's not part of my lease payments. What would you debit when you capitalize the initial? You are going to debit the asset, Mr. Armstrong. Maybe you should concentrate, then you won't be asking silly questions. Not if there's a silly question. No question is silly. You can ask whatever you want, but you will debit the asset to capitalize it, and you will credit back. Okay. Good. Okay. Okay. No disclosure for the variable lease expense. There will be, because it will be part of my. But we'll get to the disclosure. Gosh, you guys are so excited about leases. You want to jump like 7 slides ahead. So when you get to the disclosure, you'll see that where we disclose our income and expenses related to leases, we will disclose our variable lease expense. Okay. Good, but it will not be part of the straight line. Okay, I am hiding the comments again, so zip it. Okay, so let's look at our what happens in this example. So first of all, we have our machine with a carrying amount of 320,000 that's depreciated over 10 years. Then we enter into this lease. It's going to be the lease term is going to be 4 years, and our monthly lease payments will be 4,000 for the first 2 years, 4,200 for the next year, 3,500 for the 4th year. Now we know from paragraph 81 that we have to straight line. So paragraph 81 says that we have to straight line the lease income unless there's another systematic basis, which there isn't in this question. So we're going to straight line that expense. However, now we come back to that non-lease component. So if we go back to paragraph 15, when we spoke about the non-lease components and the non-lease components, you got that last year in FRK 201 already. We saw that for the practical expedient, the lessee may elect by a class of underlying asset not to separate non-lease components from the lease components. However, this is just a decision that the lessee may take. The lessor does not have that option. So the lessor has to separate lease components from non-lease components. Okay. So therefore, now in this question, we have some non-lease components. So let me just quickly delete my markings. Good. So we have some non-lease component, which means, which means the following. Oh, now it doesn't want to page. Blah, 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 blah. Mr. Plessis, do you have some solutions for me now? Mr. Tsesi, don't laugh at your lectures. That's very, oh, you're not laughing at me. Never mind. Okay, sorry, I'm trying to page. Let me just go out, discard, go back in, see if we can do it now. Yes, thank goodness. Okay, good. So the lessor does not have that option. The lessor has to separate the lease components from the non-lease components. So when we do our straight lining, we will only be able to use our lease component. Because remember now, the question said, included in these lease components are the 250 Rand per month for insurance. Good. Okay, and then we have our variable lease payments, which will be 5% of the actual sales. And we know that variable lease payments are not included in the definition of lease payments unless it's linked to an index or a rate. Good, so therefore it's not going to be part of my straight line. Then my initial direct cost, we said that should be capitalized to the asset by debiting the asset and crediting bank, and we'll depreciate that over the lease term. Okay, and then we got that from paragraph 83, which spoke about the initial direct costs. Okay, so now we calculate our straight lining of our lease income. So we'll say, okay, for the first 2 years, the lease component will be the 4,000 less the 250 for 24 months. Then for the third year, 4,200 lease income less the non-lease component for 12 months. And then for the fourth year, 3,500 less the 250 non-lease component for 12 months. We add all of that together, divided by the 48 months in total. That gives us a straight line lease income of 3,675. Good. So quickly check before we go into our journals. Okay, so when we go into our journals, what we see here is now when we account for this, we're only going to account for it at the we're going to account for it every month when we receive our the lease income. So therefore, there's no initial recognition on day one on the commencement date of the lease. There will be no journals, although we will have our I wonder if I have that here. Yeah. So our initial direct costs, this journal will actually happen on our commencement date. So that will be the 1st of, what was it? The 1st of July 2014, I think, was our commencement date. Am I right? Oops. Yes. Okay, so that journal would have actually happened on our commencement date, but that's the only one. That's when we incurred our initial direct cost. So that's what this is, the initial direct cost, where we credit bank and debit the machine. Okay. Okay, so then for the year then, what's going to happen is we are going to have our operating lease income, which will be calculated using the straight line lease income for 12 months. However, we have actually received 4,000 Rand for 12 months in that first year. So that's a debit to bank of 48,000. But part of that 48,000, we had our insurance recovery amount of 3,250 for 12 months. And in the balancing amount in this journal now is an income received in advance, operating lease income received in advance. And we have this amount because of the straight lining. So because of the fact that we've straight lined our income, we now have this 900 Rand difference, which is an income received in advance. Okay, this insurance recovery, just note that this insurance recovery will go to my P&L as it's going to decrease my insurance expense. So it's actually going to go to my other expenses in my blocking, because it's decreasing my insurance expense. Okay, so the next journal that I have at the end of the year, now in the question, in the note part under my required, please make you read that note information under required. You know where it says required and then asks you what you have to do, and then it says note with some bullets. Please read that very carefully. For example, I know that most of you don't read it because in the CV, in that note information, we did not say that you can ignore comparative amounts, which means that if you did not do comparative amounts, you would have lost about 7 marks in your CV. So the note information is very important. So we would have seen in this question, it tells us that assume that the estimated sales was actually the actual sales per year of the lessee. So therefore, my variable lease income will be the 5% of the 450,000 actual sales from the product we know by the lessee. So here we are accruing for our this variable lease income. Remember, we are only going to receive this on the 15th of August in the next financial year. However, it has already accrued to us. So therefore, we are accruing that income, recognizing the income and parking it on our SFP as accrued income. Okay, we've spoken about our initial cost, the next journal, and then the last journal is just the depreciation for the year, where we have to remember that the asset itself is depreciated over its useful life, but the initial direct costs that were added to the asset is only depreciated over the lease term of 4 years. Okay, so that's the journals for the first year. Let me quickly check the chats. Come on. Okay, so it's treated similar to low value asset, yes. I'm not sure if I missed it, but why is it necessary that we have straight line the income? I get the standard says it, but what is the reasoning behind it? Because sometimes a lease transaction is structured in such a way that we want to incentivize the lessee to lease it for a longer period, for example. So we will have a higher lease expense at the beginning and then smaller lease payments later on. However, we know that we have to, we are working on the accrual basis, so we are not going to, the benefit that we are going to get, or the benefit from using that asset is not going to change over the lease term. So therefore, that income, although we are getting a lot now and we're going to get less later on, the income that accrues to us will actually be the same over the lease term. Okay, so that's why we are doing it. Or the other way around, maybe we are charging a less lease income now, but later on it's going to become higher. The benefit is actually going to be the same. Good, Mr. Groenewald, L to you as well. I don't know what L means. I will have to go and Google that or ask my children. Don't you think 7 marks a bit harsh, ma'am? No. Okay, Mr. Mangali. Okay, so for the lessor, we use an accumulated depreciation account, and for the lessee, is it the right of use asset account when accounting for depreciation? Yes, so remember now that IFRS 16, with regard to operating lease, tells us how to account for the lease. So IFRS 16 does not tell us how to account for the asset that we are leasing out. The asset will still be accounted for in terms of IAS 16 or IAS 40 investment property. So therefore, the depreciation we deal with that the same way we would for IAS 16. So this is actually an IAS 16 journal that we are doing here. That's why we have accumulated depreciation. Whereas with a lessee, when we have a right of use asset, the standard there, IFRS 16 tells us how we have to account for the right of use asset. And there the standard says, don't use an accumulated depreciation, just put it straight to the right of use asset. Okay, obviously if you do use accumulated depreciation, your disclosure, your financial statements will look exactly the same. So I don't want to say this on video, but if you did use an accumulated depreciation account, you get penalized for that, then I would go and fight for it if I were you. But don't quote me on that, and don't screenshot this section of the video and show it to the CTA lecturers. That's our secret. But I think you would have a good case to do that. Okay. In an operating lease, no, I thought the lessor didn't account for depreciation. No, the lessor will account for depreciation for an operating lease. For right of use asset, if it's a finance lease, the lessor will not have depreciation. But the question had to do with whether we are using a separate accumulated depreciation account or not. Okay. In an operating lease, we don't recognize that we'll still have depreciation. Yes, because the lessor will have risk. In finance lease, we do recognize as, and therefore there is no asset depreciate. For the lessee, the right of use asset is recorded carrying amount. For the lessor on an operating lease, the asset is recorded cost, and a separate accumulated depreciation account for specific asset class is used. Yes. Okay, so for those of you who are watching this video and cannot see the chats, I was just quickly going through the chats now, reading it too, but it's everything in that they said in the chat is what I've already explained to you. I will just maybe repeat the last comment that said, for a lessee, the right of use asset is recorded at its carrying amount. For the lessor under an operating lease, the asset is recorded at cost and a separate accumulated depreciation account for that specific class of asset that is used. Yes, so because it's done in terms of IAS 16. If we have an asset under an operating lease, it's, the asset itself is accounted for under IAS 16 or IAS 40. Okay, so that's the comments and the questions. And now we can go and look at disclosure. Okay, so you can, just to go back, you can now go and have a look at the this example here. We've only now looked at the journals for the first year. But what you will see in this example, the journals are actually done for all 4 years of the lease. And you'll see that every year this income received in advance, so it increases with 900 in year 1, then increases again with 900 in year 2, then it increases again with, I can't remember how much in year 3, and then in year 5, because then the lease payment is smaller, and year 4, the lease payment in year 4 is smaller than it was for the other years, then that income received in advance swings around so that after the 4 years, that balance is 0. So just go and have a look at the journals for the other years as well. Okay, so now we are getting to disclosure. Getting to disclosure, what do we disclose for an operating lease? And we find that the disclosure requirements in paragraphs 89 to 94. Okay, so first of all, in that first section of our note where we have our income and expenses related to leases, here for an operating lease, we will disclose the lease income that we've received from the operating lease. So that will be so that will be the actual income that we've recognized from P&L. So therefore, it will be the straight line lease income that we've recognized, not the cash flow, the straight line lease income. Okay, so and we will have to show whether it's from operating, whether this income is from investment property or from other assets. Okay, in terms of paragraph 90, part B. So we'll just split it: lease income from investment property and lease income from other assets. And then we also will show any income that we've received for variable lease payments that are not linked to an index or a rate. So that will be the 5% that we are going to receive on the sales. Good. Now, the next sections of our note here, the net investment in finance lease, the maturity analysis of the net investment in finance lease. Obviously, that does not apply to the operating lease. However, we have this new section to this note, which says lease payments receivable from operating lease contracts, which in essence is the same as the top section of my maturity analysis of my net investment in the finance lease, because here again we are disclosing the undiscounted lease payments that we are going to receive for year 1 to 5, or year 1, 2, 3, 4, 5, and then the total after year 5. Now, if I remember correctly, then actually in paragraph 9, remember for the finance lease here, we said that we will give you the bands. We'll tell you what the bands are. However, for the operating lease, if I remember correctly, IFRS 16 actually tells us that this should be the bands that should be used. Okay. So I'll tell you that. And also important to note that in this section of the note, here we are going to show the cash to be received. So not the P&L income that we are going to get. Here we show the actual lease payments that we are going to get. And luckily here in this section of the note, we don't have to worry about unearned finance income or anything like that. We don't have that for an operating lease. It's literally just these are the cash payments that we are going to receive in these 5 years, and then after 5 years, the total. Okay, so that's the disclosure. We will later on, we'll get to the IAS 40 disclosure. So just know that there is some additional disclosure in terms of IAS 40 that we'll deal with later. Okay, so that's disclosure then for operating leases. We check our checks, see if Mr. Armstrong and Mr. Schrempel has behaved themselves. Why are you thanking everyone, Mr. Armstrong? Okay. Mr. Mangale, I'm under this assumption that we must combine both types of leases in the note. Yes, because it's the same note. We use the same note for lease agreements, all lease agreement in which the company is the lessor. So we use the same note and we throw everything in there that has to do with finance leases or operating leases. Ma'am, for the variable lease, should it be the amounts already received, or it also includes the accruals? Now, remember we said here we are showing the P&L amount, so the amounts that we have recognized in profit or loss, the income and expenses that we've recognized in profit or loss. So it will include the accrued variable lease income that we are going to receive only later, but it has accrued to us in the year. It's been recognized as an income, therefore it goes into this section of the note. Okay, ma'am, for the variable lease, should it be the amounts? Monuts. I read when I saw that comment, I read donuts. Never mind. Okay, so but I suppose you're not talking about donuts, ma'am. For the variable lease, should it be the amounts already received, or it also includes the accruals? Okay, I've answered that question. It should be the accrued income because that's the income we recognized for the year. If the variable lease payments are linked to an index rate, what now for disclosure? So if the lease payments are linked to an index rate, what should be disclosed? So then what's going to happen, then those lease payments, if they're linked to an index rate, then we are not going to be able to straight line them, first of all. So then we will just, whatever the income is that we get, that is going to be the lease payment that we get, that's also going to be the income. And then that will be the payment that's going to go into this top section of the note. Okay, because if they're linked to an index or a rate, then we won't know how the index or the rate is going to change in future. Therefore, we won't be able to straight line it. Okay, maybe please go back to the presentation slide quickly. We are there now. And also in a question, should I go out so that you can see it properly without my doodles? Okay. And also in a question, if they do say anything about excluding comparative years, it has to be included in our answer just to confirm. Now, if they say you can ignore comparative amounts, then you only show the current year's amounts. But if the note information does not say anything about comparative amounts, then you know it should be disclosed, because that's part of disclosure. That's something that has to be disclosed as comparative amounts. Unless I tell you, don't worry about comparatives, just disclose the current year information. Good. Would the insurance amount be part of income expenses part of the note? No. So the insurance, the non-lease component is exactly that. It's a non-lease component. It's nothing to do with, although it's stipulated in the lease that it's something additional that the lessee should pay, like I said, that's going to go to your other expenses. It's going to decrease your insurance expense for the year. So therefore, it's not going to be included in your income and expenses related to leases. Okay. So that seems like all the comments and questions. Mr. Armstrong, you wanted me to go back here to the disclosure slide. I don't know if you have any specific questions. It would be expensed as normal in the splokkie. I assume you're talking about the insurance. Yeah, I'm going to pay, as the lessor, I'm going to pay insurance on all my machines. But now this specific machine, I am leasing out in terms of an operating lease. And for that lessee, I said to him, I want the insurance money on that machine back, which the lessee is going to pay me, and then that's going to decrease my overall insurance expense in my story. Okay. Okay. Let me, seems that I've addressed all the chats there, so let's hide that again to protect me against myself. Okay, so we're looking at disclosure. So here we have that, so we have our journals here and the note. The notes so this is now example, what's example 19, I think, if I remember correctly, don't I have, I think it's example 19, but anyway, so if we now look at our journals and we compare that to the note, you'll see that first of all, the depreciation expense, depreciation will always be disclosed, and we're now just looking at 2015. Depreciation is always disclosed in our profit before tax note, so therefore the depreciation will go to profit before tax note. That's normal IS1 disclosure. The operating lease income, so the actual straight line operating lease income, is disclosed as part of my income and expenses related to leases. The variable lease income that I've accrued for the year, not yet received, I've accrued for it, but it has accrued to me in the current financial year. So that's also disclosed in my note, income related to the variable lease payments. And then also note that we are, like I said, but we'll get to that when we look at IAS 40, we'll have to split the disclosure between what was the income for investment property, IAS 40 investment property, and what is the lease income for other assets. And again, over here as well for the variable. We split that between from which assets generated this lease income. Okay, and the last one was the insurance recovery. As I told you, that just will go to other expenses to decrease my insurance, expense. There we go. So that's the blue circles. That just goes to my other expenses. So it's a credit, so it's going to decrease that expense. Okay, so that's the income and expenses related to lease income section of my note. The next section, that last section that we are now adding for the lease payments receivable under the operating lease contracts. Remember there I told you this is the actual cash amounts that we are going to receive. So now we are doing this note. This note is now for 20x15, but we are telling the users for the in the future years, what is the lease income that I'm going to receive. So for 2016, that will be year 2 of my lease. We are going to receive 4,000 less the 250 insurance for 12 months. So that's the amount that I'm going to receive in future, in 2016. And then for year 3, which is 2017, it will be 4,200 less the 250, and that's the amount over there. And then in 2018, it will be, why am I missing a year? 2016, 20. Okay, yeah. So and then in year 4, it will be the 3,500 less the non-lease component times 12 months, 39,000 that I'm going to receive. So this is then the lease payments that we're going to get in year 1, in year 2, in year 3 after my year end. For 2016, obviously, then this is going to be year 1 and year 2. Okay, so that's the disclosure. Let's quickly see if there are any other comments or questions. Yes, so it's this is the disclosure in example 19. Thank you. What do the asterisks mean next to lease income from straight lining of lease payments? Okay, we'll have to look at our example. Let's see if I have that in here. Example 19, yes. So is there an explanation for the asterisks? I think it might just be to say The fact that it has to be split between the investment property and the other assets, I'm not sure. So if it's not there, if the explanation isn't there, then I will add it for next year, and you're welcome to join us next year and then know what the asterisks means. I think that's what they were supposed to be. Okay. Oh, was it? Okay. So we must also not include the non-lease component in the undiscounted lease payments disclosure. No, because they are not part of my lease payments. Non-lease component is not part of my lease payments, unless you're a lessee and you've decided to include it. But for lessor, it's not part. So the page above the beginning of example 19, is that the asterisks now, Mr. Armstrong? So, okay, never mind. If one of, okay, so the asterisks, they mean if one of more of the underlying assets are investment property, IAS 40 specifically requires that the rental income from investment property is disclosed. Thus, if the underlying assets are both investment property and other assets, then this distinction would presumably have to be made here. Okay, so that's exactly as I said, the fact that we, so these asterisks over here just refer to the fact that I have to split the investment or the lease income between what was generated from investment property and what was generated from other assets that were leased out under an operating lease. Thank you, Mr. Armstrong. That was a valid comment. Okay, good, thank you. But I like your other comments as well, but it just does not videotape that well. Okay, so the next example, example 20, that just deals with presentation. So in the presentation in the financial statements, so that is on the face of the SPLOCI and the SFP. I think in this example we only show you the SFP because in the SPLOCI there won't be any specific presentation there that we have to disclose. But even in example 20 on the SFP, the only thing you are disclosing there is the carrying amount of the asset, the property, plant and equipment, as well as then the income received in advance. Okay, but go and have a look at example 20, but there's nothing weird or new. That brings us to the tax. Let me quickly check the time. What time did we start? 9:30, so I've still got another half an hour. Okay, so that brings us to the tax. So let me quickly just again check the chats. Yes, Mr. Armstrong, you are definitely making up for it. Thank you. Okay. Oh, there was a comment that just came in. Let me check. Ms. Swanepoel. So for the lessee, elect practical expedient included in undiscounted lease payments. Not elect practical expedient. No, but remember now the lessee will not. Yeah, but just remember, you have to look at the disclosure requirements for the lessee. But for the lessor, definitely you cannot elect that practical expedient. Therefore, it is excluded from the undiscounted lease payments. Good. Okay, so we're getting to tax. Differences between the accounting treatment and the tax treatment. So here you'll see that there's actually nothing strange or nothing new from what we had in our IAS 12 lectures. Because first of all, the receiver says, okay, lessor, you are the owner, so you get wear and tear. And for accounting purposes, we also say, yes, we are the owner, we're still recognizing that asset, and therefore we will have a depreciation expense. So there will be temporary differences due to wear and tear and depreciation. Just like we did in IAS 12, nothing weird or strange there. Then we will, when we receive the lease payment, the full cash amount, so the cash amount that is received will be taxable. However, remember for accounting purposes, we might have recognized that lease income on the straight line basis. And if that's the case, what's going to happen is we are going to either have income received in advance or an income receivable account, accrued income account, which means that again we are going to have temporary differences. Temp diffs. That's what stands here as temporary differences. Okay, so and that's again exactly what we did in IAS 12. So nothing new, nothing strange with regard to the tax treatment for an operating lease. So we know how to account for difference between wear and tear and depreciation in our current tax calc, as well as how to account for income received in advance or accrued income in our current tax count, no issue. And then we also know that we are going to have a difference between our carrying amount and our tax base of the asset due to the differences in depreciation and wear and tear. And we are also going to have these SFP balances, which might have different tax bases. So no issue there, no problem, nothing weird or strange for tax. Okay. So example 21 uses now the same example we did now in example 18, 19, and 20. The only additional information they tell us is that they give us our profit before tax of 400. No, profit before tax 400,000 and 500,000 for these 2 years, and they say that that is the amount before the operating lease agreement had been accounted for. Okay, and then they also give us some information on the wear and tear, the tax treatment of the different amounts. But let's just stop here for now. So it gives us these before tax amounts before the operating lease agreement has been taken in, has been accounted for. And then it asks us in part A of the question, if I remember correctly, it asks us to calculate the actual profit, the final accounting profit before tax. So we have to calculate what the final accounting profit is before tax. So this was like a preliminary profit that was calculated, but the new accountant did not know how to account for operating leases, so nothing was accounted, and you now have to come in and fix it. So what we'll have to do is we first have to include our operating lease income, and that will be our straight line income that we will have to add. Our variable lease income, so that's the 5% on the sales that we will have to add as an income. The insurance recovery, remember this is going to decrease my insurance expense. And then the depreciation of the machine, the full depreciation of the machine that has to be deducted. And that gives us now our final profit before tax. Okay, now part B, we have to go and calculate our taxable income so that we can calculate our current tax. Before I do that, quickly check the chats. Well, I should have done this long ago to hide the chats. Good, nothing there for now. Okay, so now we do our, we are calculating our taxable profit. So we start with our final accounting profit that we have just calculated. And now we go and we reverse the accounting and we bring in the tax treatment. So they told us in this question that there's dividend income and fines. So obviously we will go deduct the dividend income and add back the fines because that's not taxable for tax purposes, and this is not deductible for tax purposes, so we have to reverse that. And then under the temporary differences, we just have our normal IAS 12 where we add back our depreciation and then we deduct our wear and tear allowance. So they've told us there in example 21 the wear and tear allowance. I can't remember what it was. Let's go and check. Let's do it properly. Let's try and skimp on it. They told us that allowance was granted at 12.5% on annum on the cost of the machine, and they also tell us that the initial direct costs. I wish I could show you now here and there. I don't know how to show you, but the initial direct costs of 480 are deductible in the year in which they are incurred. We know what our allowance, wear and tear allowance, 12.5%. And then they tell us that last sentence above the required that the variable lease payments are not based, variable lease payments that are not based on an index or a rate are taxed in the year in which they are first recognized. So in the year when they are accrued, that is when they are going to be taxed. So that's what the additional information that they give us in class example 21. Okay, so that means that for that variable, the variable lease income will be included in my accounting profit before tax, and it will also be taxed in that same year. So therefore, we will not need to make any adjustments because it will be automatically included in taxable profit. So that's our variable lease payments. Good. When they tell us the initial direct costs are deductible when they are paid, remember for accounting purposes, we actually included it here in our depreciation expense because for accounting purposes, we are going to expense it as depreciation over the 4 years, whereas for tax purposes, it's expensed in full when we incur those initial direct costs. And then we have our income received in advance. Now, remember how income received in advance works. We are taxed on the earlier of when we receive the money versus when when it accrues. Earlier of the two, and in this case, we've received the cash earlier than we've received the cash, although it has not yet accrued to us, and therefore this income received in advance will be taxable. We have to add that back. But the easy way of calculating this is just to say, okay, let us reverse the accounting income, so the straight line accounting income, let's take that out, and we add back the actual cash that we have received, because that is what we will be taxed on. And the difference between these two gives us our income received in advance. Okay, and that then gives us our taxable profit multiplied by 28% gives us our current tax. Okay, so any comments or questions there up to now? Let's see. 12.5%, thank you. That line amount is deducted in the current tax calc because it was already previously deducted from accounting profit. No, it's deducted because it was added. It was so that the straight line accounting income over here was part of my income to my final accounting profit before tax. So that's why we deduct it now to say, okay, but we are not going to be taxed on the 44,100. We are going to be taxed on the 45,000. So therefore, because the 44,100 is included in here, we say, okay, now deduct the 44,100 to get rid of it, and then add back the actual cash amount that we received, which is what I'm going to be taxed on. Okay, so the straight line amount is added in the current tax calc because it was already previously deducted from accounting, added to accounting profit. Yes, okay, cool. So I've answered that question. Okay, so that's current tax. Let's at the deferred tax. And again, as I said, nothing weird, nothing strange here. We have our income received in advance, which is, so it's income received in advance. That means we debited bank when we received the money, and we would have credited income received in advance. So that is a liability. So a liability, or the tax base of a liability, will be the carrying amount less the amount. Income received was the special definition. The carrying amount less the amount that will not be taxed in future. And because we've already been taxed on the full amount, the carrying amount is the amount that will not be taxed in future. Therefore, the tax base is 0, giving us then a deductible temporary difference of 900 Rand, which makes sense because it's deductible temporary difference, because what's going to happen in next year, I am going to have this income, or not next year, over the lease term. It actually happens only in the last year, the 4th year. I'm going to have this higher income than the amount that I am actually going to be taxed on. So that's why it's a deductible temporary difference. Okay, so income received in advance, it's fine. We know that from our IAS 12 lectures. You should know that from your IAS 12 lectures. We have the accrual amount for our variable lease income. So there we said credit variable lease income, and we debited the accrued income. So therefore, this is an asset. The tax base will be the amount. No, is it an asset? Variable income, accrual, asset, yes. So it will be the amount that will be deducted in future, which is 0 because we won't have any deductions. Oh, yes, okay. But however, because this variable lease income, it's an asset, yes. But remember, we first have to determine the tax base, we first have to ask ourselves, will the economic benefits of this 22,500, will that be taxable in the future? And the answer to that is no, because we've already been taxed on that in the current year. So because the answer to this question is no, the tax base is going to be equal to my carrying amount. So that's why we don't have any temporary differences for my accrued income. Okay, because when we actually get the benefit, when we do get that that cash now on the 15th of August, we will not have to be taxed on it again because we've already been taxed on it. So therefore, the tax base is equal to the carrying amount. Good, and then lastly, just the leased asset, normal difference between the carrying amount and the tax base. Again, everything that we know from our IAS 12 lectures. Okay, so for deferred tax, nothing weird or nothing strange with regard to an operating lease. Good. Okay, so that was just an explanation of the variable lease payments. Oh, you can't see it. Yeah, variable lease payments. The fact that they have already been taxed, that's why they will not be taxed in future, giving us the tax base equal to the carrying amount. Good. A question there. Can you please explain why the operating lease income received in advance has no tax base? Because it's okay. Because income received in advance is going to be a credit liability balance on my SFP. The tax base of income received in advance, if you remember, if we look at the tax base of a liability, we saw that income received in advance is treated differently from my my other normal liabilities. So here our tax base will be the carrying amount less the amount that will not be taxable in future. Okay, so in this case, my carrying amount was the 900 Rand. So carrying amount was the 900 Rand. The amount that will not be taxable in future will also be the 900 Rand, because remember, this 900 Rand is because of the fact that the cash that we received was more than the income that we recognized. So we have been, and the difference there was, it was 900 Rand more than the income that we recognized. So we were taxed on this full cash amount that we've received. So therefore, the amount that will not be taxed in future is the full 900 Rand. So therefore, my tax is zero, because we've already been taxed on that 900 Rand because it was included in the cash that we received. Good, Mr. Mangali, I hope I answered your question. There is the 280,000 tax base future wear and tear. Yes. So that's so this amount is calculated. You'll see it's calculated as my cost less the 12.5% wear and tear deduction that we got for 2015. So it's the future wear and tear allowances that I'm still going to get. Cool, Mr. Mangali, I see that you are happy. If the tax, Ms. Swanepoel, I hope you are happy as well. Mr. Armstrong, the tax base of variable lease income accrual has no tax base. Wouldn't tax base be zero? I don't get why it is variable lease income accrual. Okay, because so this is an asset. Good. So let's clear out all my notes here. So this is the variable lease income accrual is an asset. Okay, so it is therefore income that I'm still going to receive, receivable income. So I've already recognized the income, so I've credited income and I'm debiting this income. I haven't received it in cash yet. And that's exactly the same as a debtor. For a normal trading debtor, I recognize the revenue, I credit the revenue, and then I recognize this debtor. And remember, we said with the debtor, our first question to determine the tax base is, will the economic benefits from this asset be taxable? And we said with the debtor, no, it will not be taxable, because the benefit is I'm going to receive the cash, and when I receive the cash from the debtor, I'm not going to have to pay tax on it again. It's exactly the same principle over here. So I've already paid tax on in the current year when I accrued for that that income. Therefore, when I do get the cash on the 15th of August, I'm not going to have to pay tax on it again. So the economic benefit from this asset is going to be the cold hard cash that I'm going to get, but it won't be taxable. Therefore, the tax base will be equal to the carrying amount. Okay, so Mr. Armstrong, are you happy? So, okay, so the tax treatment and the accounting treatment will be the same, therefore no deferred tax. Exactly. Okay, cool. Cool. I see your smiley face. Mtukozo, how was the carrying amount of the leased asset calculated? How was the carrying amount of the leased asset? Okay, so that was. So this was just the lease asset was my this was my original cost. I think it was 320,000 if I remember correctly, plus then the initial direct costs less the depreciation for the year. Okay, so that's how that the leased asset carrying amount was calculated. So I think if I remember correctly, it was 320,000 and 4,500 initial direct cost, and then I can't remember what the depreciation expense was. So, okay, so Ms. Floppy, are you happy? Can you see? Give me a smiley face if you're happy. It's just a normal carrying amount calculation. Okay, so it's the original cost of the asset plus the initial direct cost that we capitalized, and then we calculated most our depreciation expense. We did the journal for that. Cool. See, you are happy. Tax treatment account, will wear and tear be allowed on the initial direct cost? Now, remember in this question, I specifically told you that initial direct costs are deductible when they are when it is incurred. So it will not be included in your wear and tear calculation. Good. So for accounting purposes, we are expensing it as depreciation over the 4-year lease term as part of my depreciation. Tax purposes, we get once-off deduction in year 1. Mr. Schrempel, the carrying amount would be the cost of the asset plus any initial direct cost. Okay, thank you. Thank you, Mr. Schrempel, for answering that question. Good. This is going so much better when I hide your comments while I'm lecturing. Cool. Should have done it a long time ago. Oh, there I have my calculation. Of my carrying amount. I forgot about that. There's the calculation of the carrying amount as well. And the wear and tear. Good. Okay. Okay, so that brings us then to the end of operating leases. Yes, and because Liam is keeping quiet and he's gedraaing himself. Don't know what gedra is in English. Behaving, he's behaving himself. Good, thank you, Liam. So we have got, let me just quickly check, we've got 10 minutes left. So in this last 10 minutes, I just want to give you a quick recap of the lessor. So just a quick recap of everything that we've done for the lessor before we end our last lecture of the quarter. Tonight I'm drinking wine. Okay, so first of all, we looked at a finance lease, an incidental lease. Sorry, there's just a question again, Ms. Swanepoel, before I carry on with my summary. So the carrying amount includes the depreciation on the well, the carrying amount includes the amount of the initial direct cost that has not yet been depreciated, but in the tax base, it's only the wear and tear on the original cost of the asset. Yes. So here, for our carrying amount, we are including the initial direct cost, whereas for the wear and tear, we are not. Okay. Okay. So, quick recap of our normal finance lease. So this is just, I call it an incidental lessor, but it's just actually a normal finance lease. So we've got some differences here for the manufacturer dealer lessor, but our normal finance lease lessor, let's just quickly recap that. So first of all, remember that for a finance lease lessor, we will have 2 separate GL accounts, which will be my gross investment in the lease, which will be a debit balance, and the unearned finance income, which will be a credit balance. And the gross investment in the lease will consist of all my lease payments that I am still going to receive. And this will include my residual value guarantee, because that is part of lease payments, the definition of lease payments for the lessor. And then specifically also when we look at the definition of gross investment in the lease in Appendix A, it tells us that the unguaranteed residual value should also be added to a gross investment in the lease. Unearned finance income is then calculated using the interest rate implicit in the lease. Okay, what do we do with initial direct cost for the lease, for a finance lease lessor? It's not recognized separately. There isn't a separate journal for that. It is part of my initial recognition journal, and it actually, the effect of it is that it decreases my unearned finance income at initial recognition. Okay. So, and remember also that when we calculate our interest rate implicit in the lease, the present value is going to be the fair value of the asset plus the initial direct cost that we have incurred, and that is why it decreases the unearned finance income, because the lessor is giving up more it's incurring initial direct costs than it would have without the initial direct costs. Good. Then what do we do when our financial year does not equal our lease? Then all we have to do is we have to accrue for the finance income up to our year end. And how do we do that? We debit our unearned finance income and we credit our other finance income in our P&L. Okay, so that's how we accrue for that finance income that we have earned but we have not yet received, because of the fact that my financial year and my lease years are different. Okay, so let's see, I've got some chats there. Any deposits received will also decrease the present value. Yes, so if there were any deposits that we've received, then that will also decrease the present value. Good. So then what happens when there's a change in my interest rate, when we have a floating interest rate? Then what we do is we stop our amortization table when that interest rate changes. So and that's we're going to stop it because what's going to happen is the interest rate is going to change, but we are only going to account for it. We'll account for it at the beginning of a lease year. So then or a lease period. It might be a month, but usually for our case, in our examples, it's always a year. So we'll stop our amortization table when that floating interest rate changes. We'll calculate what our current balance and what the current balance is of our net investment in the lease. Then we'll use that this current balance of our net investment in the lease as my present value to calculate what my new payment should be using my new interest rate. And then when I've got my new payment amount, I can now go and calculate what my gross investment in the lease should be, as well as what my unearned finance income balance should be. Because now remember, this is going to change because I've now got new lease payment amounts. But because of the fact that my net investment does not change, it means that the net amount of these two will also change. So whatever say, for example, I have to add something to my gross investment in the lease, the same amount will have to be deducted from my unearned finance income so that the net change in my net investment is zero. So remember, the net investment does not change. It's just the future payments and the future interest that's now going to change. Okay, and then we do a new amortization table for the remaining period using the new payment and the new interest rate, and we will, like I said, we've adjusted our gross investment and our unearned finance income, and will be adjusted with the same amount. So that will just be the journal that we do for a change in interest rate. Good. What if there's a change in the unguaranteed residual value for the lessor? Then we will calculate the balances before the change. So again, we'll stop our amortization table. We'll stop and we'll say, okay, what are the balances of my gross investment in the lease and my unearned finance income? Then we will go and do a new amortization table. So using this new unguaranteed residual value, which will now be unguaranteed residual value, will now be my future value that I'm going to put into our calc, and we will calculate, do a new amortization from the beginning of the lease term, and we'll use this to calculate what the new interest rate should be after this change in the unguaranteed residual value. And then when we've done that, we'll calculate, okay, so based on this new amortization table, what should my gross investment in the lease and my unearned finance income be? Then we'll adjust these balances from what they are at the moment, what they should be. And these two amounts now are not going to be the same. So therefore, there's going to be a balancing amount, which we will just take to our finance income. Okay, and this is accounted for as an IAS 8 change in estimate. Good. So the only thing that you have to remember here is the fact that we do our amortization from the beginning. So we'll stop and we'll say, okay, what would the amortization table have been like if the new unguaranteed residual value was the unguaranteed residual value at the beginning of the lease term? And then calculate what our balances would then have been. Okay, and before I get to the tax, let's quickly check 8 chats since I checked it last. Okay. So do we have to call it other finance income, or is finance income okay? Please call it other finance income. You'll see in your notes that we specifically said that it should be other finance income. So when you get to IFRS 9 financial instruments, you will see that the what the reason for that is, why we have to split that finance income. But please call it finance income, yes. Good. Unearned finance income is basically an account that you hold for the entire lease term, and then you allocate to other finance income according to the financial year end. Yes, so unearned finance income is this credit that I'm parking on my SFP of my future finance income. And then as I earn the finance income, I'm going to release it. I'm going to decrease the unearned because I have earned some of it, making the unearned balance smaller and smaller and smaller and smaller. And I also need well, it's a credit, so I need this credit balance to put next to my gross investment in the lease, so that the total of the two gives me a discounted amount, a present value of my net investment in the lease. Okay. Next question there. What happens in the rate changes in the middle of the lease term? Okay, so if that happens, so what's going to happen is that these are now our lease years. So now the rate is going to change. We've got this floating interest rate. So here it usually happens. I think it's the first Wednesday of a month, the last Wednesday of a month when the Reserve Bank, when they meet and they decide on the changes in the repo rate. However, what's going to happen, and it's going to definitely happen for our purposes, now with us and CTI, I've checked with them as well, is the payment is going to, even if the announcement is made over here that the rate changes, that the repo rate changes, this change is only going to affect my next lease term, next lease period. So whether that's a year or a month or whatever it is. So even if it happens over here in the middle of let's say that our lease payments are paid annually, so it's every year. So even if that change happens over here, it's only going to affect my my next lease payment. Okay, so in our case, we will always have it that the change actually happens at the end of a lease term, like the day of the last day of the prior lease term or the first day of the next term. Doesn't matter. It's only going to affect my next lease term. So it's only the cash flows are only going to be affected for the next period. Okay. So therefore, don't worry about it. It's not going to happen. For our purposes, it's not going to happen in the middle of a lease year or a lease month or whatever the case may be. Goed. Mr. Mangali, hold for the entire lease and then you allocate the funds income. So I think I've answered your question. Thanks really are Mr. Dependable. Hey. I am Mrs. Dependable. Mr. Armstrong is just here on invitation. Okay. No, I'm joking. I actually like it that you answer each other's questions. Goed. Also, what happens if the unguaranteed residual value changes in the middle of the lease term? It's not going to happen. It will change. It will change it will either change. Well, I suppose it might change at the end of my It might change at the end of my financial year, or it might change at the end of the lease term. But then, yeah, you'll just calculate what your balances are, and then make the adjustment. So even if we have a situation where this is my financial year end, so and the unguaranteed residual value changes over here, you can still go and calculate your balance for your gross investment and your unearned finance income balances on this date. You in any way have to do that, and then you'll make those adjustments. Okay, well, these slides you went through will be uploaded onto ClickUp, or are they already? There are slides on ClickUp. I don't think these summary slides are there, but I'll load them for you if you think it will help. Okay, the IFRS master. I prefer to think of myself as the IFRS queen, the dancing IFRS queen. Oh, we are a minute over our time, but you went over your time with auditing, so I'm also going to go over my time with now as well. Okay, so just the tax on the finance lease. Remember, for our current tax for the finance lease, what we have to do is, because the thing is with the finance lease now, the lessor, for accounting purposes, the lessor is de-recognizing the asset and recognizing a net investment in the lease, and then recognizing finance income on that net investment in the lease. Whereas the receiver is saying, sorry, I don't see any finance income. What I do see is an asset that belongs to you, so you're getting wear and tear, and I also see a rental income that you are getting that you will be taxed on. So therefore, in my current tax, I'm going to have to go and eliminate the finance income, get rid of that to clear it out. Then I'm going to say, okay, now I am going to be taxed on the full lease payment. I get a deduction of my wear and tear, and if there were any initial direct costs, then they will also be deductible when they are incurred. Okay. Deferred tax. Only funny thing there is now for accounting purposes, I will have my net investment in the lease, which will consist of my gross investment in the lease less my unearned finance income balances at year end. And then my tax base will just be my future wear and tear allowances. So that will just be a normal tax base for an asset as we calculated it in IAS 12. Okay, so that's for the finance lease. Manufacturer or dealer lessor, as I said, there's that video. You can go and have a look at that. Then what happens for the operating lease? Remember that we usually straight line the income unless I give you some specific guidance that it should not be straight lined. And yes, there is a little bit of uncertainty whether that systematic basis that the standard talks about, should that be based on the benefit to the lessee or just the benefit in general. So that's something that's a little bit unclear. So as you've seen now, I told you that it's not actually, it's not necessarily linked to that specific lessee. However, if I tell you in a question that this is how the lessee is going to get the benefit, then we will link it to that. Okay, but it will be clear in a question. Don't worry, I'm not going to try and catch you out with that. Okay, so initial direct costs, we add that to the asset. But it will be depreciated over the lease term. So it's like a separate component that we have for IAS 16, similar to that. And then we'll disclose our income and expenses from the operating lease and our undiscounted lease, which will be the cash amount. Income and expenses will be the P&L amounts. Undiscounted lease payments will be the cash amounts. Okay, so then for tax, remember that's just normal IAS 12. Difference between depreciation, wear and tear, and then if we did straight line, we might have income received in advance or accrued income. And then again, deferred tax, just as like we had for IAS 12, we'll still have a carrying amount of our underlying asset and the tax base, nothing weird. And if we had straight lining, we might have income received in advance or accrued income balances that has to go into the deferred tax. Okay, so that's it. So yes, go and look at all the examples that we did, everything that we did now. Go and check out you can now do all the questions in the that we've handed out to you, and then you just now have to study for your year tests. And like as I was telling you, they don't stress, just do your best and forget the rest. No one passes FRK 300 in May, and no one fails FRK 300 in May. It's an important test. You have to do the best you can and make sure that you get that warm fuzzy feeling when you study for it. But remember that it's going to you're preparing for a career and not just for a test. And if it doesn't go well, that's fine. There's still be time to make up. If it goes well, good, but don't get overconfident and stop studying. Okay, so thank you so much for all your comments and your questions, and I really enjoy these live lectures. It's so much better than just doing videos. I just mean no one passes or no one fails in May. You can't in May, we can't at the end of May say these the students are passing and these students are failing. That's what I mean. I'm just saying that don't lose hope. That's basically all I'm saying. Just study for it, do as well as you can. But if it doesn't go well, don't lose hope. There's still a lot left of the year to study to fix it. But obviously, hopefully there won't be anything to fix. Hopefully you'll do very well in the tests. Okay. So don't worry, stress too much about it, Ms. Swanepoel. Okay, thank you all. I really enjoy it, and I'm going to miss you for the next month. See you then on the 17th of May for our next lectures. Yes, seeing you on the 17th of May. Okay, bye. Keep well. Ooh, maybe we should play out with some music. Only 30 of you left, but that's fine. What was I wanted to play you this one.